You see these headlines all the time, right? These massive corporate mergers, two giant companies joining forces in some multi-billion-dollar deal. And the talk is always about synergy, growth, and dominating the market. But what if there's another story, a hidden reason so many of these deals end up, well, quietly failing? Let's dig in and find out what's really going on.
And this is the big question, the puzzle that's had experts scratching their heads for years. With all that money, all that talent, and all that strategy being poured into them, why does so many of these mega deals actually end up losing investors a ton of money? What is going wrong here?
All right, here's how we're going to break this all down. We'll start with the M&A value puzzle itself. Then we'll look at the official playbook, the reasons they say they're doing these deals. We'll bring in a powerful new player, the M&A advisor. That leads us to a hidden conflict of interest, the shocking cost of bad advice. And finally, we'll answer the billion-dollar question, who really benefits?
Okay, so first up, let's talk about what researchers call the M&A value puzzle. And I mean, it's not just a feeling that some of these deals go bad. The data backs it up. Study after study has shown that, on average, the company that's doing the buying often sees its own stock price take a hit right after a merger is announced.
Now, here's where it gets really interesting. It's not that every single deal is a total failure. Actually, most of them create a little bit of value. The problem is, a handful of huge, really inefficient deals are so disastrous, they just wipe out all those small wins, and then some. The final score for investors, when you add it all up, a net loss.
So if the odds are stacked against you, why do so many companies keep rolling the dice on these massive deals? Well, it's because there's this official story, right? A kind of playbook that every CEO uses to justify why this merger is going to be the one that works.
And the word you're always going to hear, the big buzzword, is synergy. It's this almost magical idea that when you combine two companies, you create something far more valuable than the two parts were on their own. It's that classic business school line, 2 + 2 = 5.
Of course, it's not just about synergy. Companies also merge to become the biggest player on the block, reduce competition. Or they do it to become more efficient, to slash costs. Sometimes it's about buying up cool new technology or special skills. And other times, it's about branching out into totally new areas. And on paper, hey, these all sound like pretty solid strategies.
And you can see this playbook in action with some really famous deals. That Zomato and Blinkit deal? Classic synergy and diversification play. Adani Group grabbing Ambuja Cements? That was a pure market power move. Every single one of these massive deals was sold to the public and to investors using these exact textbook reasons.
It all sounds so logical, doesn't it? But what if I told you there's another hidden force at play here, a motive that has nothing to do with the company's actual goals?
Okay, so let's introduce a new character into the story, the M&A advisor. We're talking about the giant investment banks, those household names from Wall Street who are kind of pulling the strings behind the curtain on almost every major deal.
See, CEOs aren't just making these calls on their own. Not by a long shot. They're relying heavily on teams of these expert bankers to find the companies to buy, to crunch all the numbers, and to get the deal across the finish line. These advisors are, for all intents and purposes, in the driver's seat.
And right here, this is where we hit the heart of the issue, a hidden, massive conflict of interest, a fundamental flaw in the system that helps explain why so many of these deals seem like they're doomed right from the very start. So get ready for this. The core problem is how these advisors get paid. They don't get paid based on whether a deal is successful in the long run, no. They get paid a huge fee when a deal closes, and that fee is usually a percentage of how big the deal is. So the incentive is simple. Do more deals, and make them as big as possible.
Think about it. The client, they want a great deal that's going to create value for years. The advisor, well, they just need a deal, any deal really, to close so they get paid. The incentives are completely misaligned. It's like paying a surgeon for just doing an operation, not for actually making you healthier. It's just wrong.
And look, this isn't some abstract theory. The entire industry is structured this way. Banks get ranked in what are called league tables, and those rankings are based on the dollar volume of the deals they close, not how well those deals actually turn out. A banker's bonus, their reputation, their whole career path, it all hangs on getting their name on bigger and bigger deals.
Okay, so we've established this conflict of interest. It's a pretty big deal. But what's the actual damage? I mean, what does this cost in real money? Let's follow the numbers.
And this is where things get, well, pretty disturbing. Research shows that when a bank is struggling, when they're under financial pressure, they are way more likely to propose, advise, and push their clients into deals that are just plain bad. Why? To generate those crucial fees and climb up the rankings, even if it means destroying value for the very client they're supposed to be advising.
And the cost of that bad advice? It's just staggering. On average, a deal advised by one of these pressured banks destroys, wait for it, $78 million in shareholder value. And that's not the fee the bank makes. No, that's the amount of money the client's investors lose, which is way, way more than the bank ever earned from the deal in the first place.
But wait, it gets even worse depending on who the client is. For companies that are new to the M&A game and are maybe a little inexperienced, the damage is 3 times higher. And for newly public companies that stick with the same bank that took them public, the loss is a mind-blowing 10 times worse. Why? Because these are the clients who are most trusting and, sadly, the most vulnerable to bad advice. So, it all brings us back to that central question. When we see these giant deals in the news, these billion-dollar headlines, who is really benefiting from all of this?
Look, the story they sell us is all about synergy and brilliant strategy. But so often, the real, hidden driver is just the advisor's desperate need to generate a fee and climb those league tables. That's the hidden truth, and it's the shareholders who ultimately end up paying the price for it.
So, from now on, whenever you see a headline about some blockbuster merger, I want you to ask yourself a simple question. Is this deal really about creating long-term value, or is it about generating a short-term fee? The answer might just change the way you see the business world forever.